Credit cards are a common method to have continuous access to a line of credit that you may draw from and repay over time. However, they aren't the only option to finance an expense, especially if you're spending tens or hundreds of thousands of dollars on remodeling your home, debt repayment, or even purchasing an investment property. However, if you own a home and have been making mortgage payments on it, you may be sitting on funding for that remodel or investment property, which is known as a home equity line of credit. Once a person builds enough equity in their home, they can borrow against that amount through a home equity line of credit, or HELOC. Because HELOCs are secured by an asset, your home, they are one of the most popular ways to borrow at lower interest rates, especially when facing high costs for needs like home improvements, college tuition, or debt consolidation. A home equity line of credit, also known as a HELOC, is a line of credit secured by your home. HELOCs gives you a revolving line of credit to use for large expenses or to consolidate higher interest debt on other loans such as credit cards. A HELOC often has a lower interest rate than other common types of loans, and the interest may be tax deductible. You may have to consult your tax advisor regarding interest deductibility, as tax rules can be complicated. HELOCs are easy to get if you have at least 20% equity already in your home, which is the case even if you haven't put much down on your mortgage in this time of rapidly increasing home values. They may offer certain benefits like lower interest rates or longer loan terms over other forms of financing, such as personal loans and credit cards. Some HELOCs may offer interest-only payments. Unlike an installment loan, borrowers can access their HELOC repeatedly as they pay down the balance, similar to a credit card. How does a HELOC work? With a HELOC, you are borrowing against the available equity in your home, and the house is utilized as collateral for the line of credit. As you pay back your outstanding balance, your available credit is restored. You can borrow against it again if needed, and you can borrow as little or as much as you desire throughout your draw period. The draw period, usually 10 years, is when you can withdraw and use funds from your line of credit. When the draw period ends, you will no longer be able to access the line of credit for funds and will be expected to begin repaying the principal. Following the draw period is the repayment period, when you'll start paying back the total amount you owe, including principal and interest. The repayment period is typically 20 years. HELOCs can give homeowners much needed and flexible access to credit on an ongoing, revolving basis if they can meet the requirements. Once ascertained, these lines of credit can serve as a backup reserve of funding for home improvement projects. Also, HELOCs have fees and conditions that every borrower should know. Depending on the size of your HELOC, you might encounter closing costs. These fees may include charges for originating, underwriting, closing, and recording your loan. Additionally, some HELOCs have initial restriction periods, lasting from a couple of months to a few years. You could be charged a prepayment penalty or early termination fee for closing the line of credit during this time. Various lenders may charge different fees, and some may even waive certain fees altogether, so be sure to ask your lender exactly what you'll be paying. Banks commonly advertise no-fee HELOCs, which require no cash to open and come without prepayment penalties. Your bank may offer targeted discounts based on your existing relationship and account balances. Plus, some lenders provide introductory pricing that lowers the rate for the first few months that your HELOC is open. You should conduct thorough research before applying, and remember that even a no-fee HELOC will at least charge interest. To be eligible for a HELOC, you need to have available equity in your home, meaning that the amount you owe on your home must be less than the value of your home. Commonly, you can borrow up to 85% of the value of your home minus the amount you owe. Furthermore, a lender generally looks at your credit score and history, employment history, monthly income, and monthly debts, just as when you first got your mortgage. All these factors could increase or reduce your chances of qualifying for HELOC. A quick reminder, if you've enjoyed the video so far, consider subscribing as we frequently upload informative and educational videos. Let's continue. Most HELOCs have a variable interest rate, meaning the rate can change monthly. The variable rate is calculated from both an index and a margin. An index is a financial indicator banks use to set rates on many consumer loan products. The index, and consequently the HELOC interest rate, can move up or down. Most banks use the U.S. prime rate, published in the Wall Street Journal, as the index for HELOCs. The other component of a variable interest rate is a margin, which is added to the index. The margin is constant throughout the life of the line of credit. As you withdraw money from your HELOC, you'll receive monthly bills with minimum payments, including principal and interest. Payments may change based on your balance and interest rate fluctuations, and if you make additional principal payments. Making additional principal payments can help you save on the interest you're charged and reduce your overall debt more quickly. Some lenders offer an option to convert a portion of the outstanding variable rate balance on your HELOC to a fixed rate. Payments you make at a fixed interest rate are predictable and stable and can protect you from rising interest rates. Now, let's cover the pros and cons of HELOCs. First, we will start with the pros. Number 1. Reduced interest rates compared to credit cards and personal loans. Number 2. You may have the option to lock in your rate. Number 3. You can borrow only what you need. Number 4. You can use the money for anything. Number 5. You can borrow more money than with a credit card or personal loan. And number 6. The interest is tax deductible. The cons include, number 1, variable interest rates could increase in the future. Number 2, there is a set draw period, usually 10 years. Number 3, there may be minimum withdrawal requirements. Number 4, possible fees and closing cost. And number 5, there is a risk of losing your house if you default. In closing, the benefits of HELOCs are outstanding, but it takes a little hassle to secure it. Now that you know about HELOCs, would you consider it for yourself or recommend it to someone else? Let us know in the comments section below. If you enjoyed watching this video, please like and share the video with anyone else you think could benefit from this content. Don't forget to hit that red subscribe button so you don't miss any of our upcoming exciting topics. Till then, goodbye and see you in the next video.